In Unit 2, I showed you the different debit and credit positions. In Unit 3, we focus on the positions and take a closer look on the accounting technique. At first, I start with the cycle of accounting or annual accounts. On the 1st January each year, you have to create an opening balance with carry-forward entries. During the business year, there are several transactions which influence the ongoing accounting. Here you have to subdivide into net income affecting and net income not affecting entries. At the end of the year, you have to do some closing entries with the closing balance as result. The closing balance affects the operating balance of the following year and the process starts all over again. So you can identify the cycle of accounting. On this slide, you can see the formal representation of an account. The shape is the same for every account. On the left-hand side, the debits, and on the right-hand side, the credits. One of the most important slides in this lecture is the following. There are 4 account types in bookkeeping. At first, the stock accounts, which includes asset accounts and liability accounts. For example, land or trade payables. On the other hand, the profit and loss accounts with expense accounts and income accounts. For example, goods and materials employed or sales. On the following slides, we take a closer look at the 4 account types and their structure. I would like to start with the scheme of an asset account like machines. At first, you can see on the left-hand side the initial stock. Your source is the opening balance sheet. During the business year, the stock increases or decreases because of several business transactions. If you maybe buy a new machine, then you have to add this value to the machine's asset account. But also reductions of the initial stock take place during the business year. If we stick to our example of the machines, you have to reduce the value of the machines due to the depreciation and amortization. At the end of the year, the account has to be closed. How to calculate the final stock amount, I will show you on the next slide. It should be noted that in the context of an account, the outs are not to be recorded with a minus sign, but on the credit side with a positive amount. If the initial stock, the adds and the outs are known, the closing balance can be determined as follows. The initial stock plus the adds minus the outs equals the final stock. And the final stock is also known as balance. After the asset accounts, we take a closer look at the liability accounts. You can see that the entries in this liability accounts are mirrored to the asset accounts. So the initial stock and the increase in the initial stock are on the credit side, while the reduction and the final stock are on the debit side. An increase in a liability account is, for example, the rise of a credit. A debt retirement is an example for the reduction of the initial stock. The final stock is calculated similarly to the asset account. The initial stock plus the adds minus the outs equals the final stock. After the 2 stock accounts, I will also show you the profit and loss accounts as well. On this slide, we begin with the income account. On the right-hand side, the credit side, all apart income amounts are posted. These incomes were only reduced if funds or cancellation bookings take place. The income amounts minus the cancellations equals the balance. And now the expense accounts. You can see that the entries in this expense accounts are mirrored to the income accounts. The apart expense amounts are posted on the debit side, the cancellations and the resulting balance on the credit side. You now know the 4 different account types: assets, liabilities, income and expense. It's very important to memorize the general scheme of these accounts types exactly.